Hi, everyone. We're going to get started here in just a minute. I just want to give people a chance to join. So just be patient with us for a minute, and then we'll get started here. And all right, looks like people are filing in, so I'm just going to go ahead and get started with the boring part before the presentation really gets going. But I wanted to introduce winning multifamily investment strategies for 2025 and beyond, brought to us by Joe Pizzuro with BreakChain in Capital Investments. And quick, I just want to give a disclosure. Camoplan does not provide investment advice or endorsements due to the nature of our industry. Camoplan is not an investment advisor, CPA, realtor, or attorney. If tax, legal, accounting, investment, or other similar expert assistance is required, the services of a competent professional should be sought. All information and materials presented on Camoplan webinars and podcasts are provided for educational purposes only. We strongly encourage you to consult with your attorneys, accountants, and financial advisors before entering any type of investment. And if you have any questions about investing with Camoplan, feel free to shoot us an email at engage@camoplan.com or give us a call at 215-283-2868. And with that, I'm going to hand it over to Joe. Joe, you should be able to share your screen, and then we're off to the races.
We'll put it in presentation mode. Okay, can you see it okay?
Yep, it looks perfect.
Perfect. Welcome, everybody. Joe Pizzuro here. Love to talk to everyone about some multifamily investing strategies. Just to start off, the reason it first attracted me to multifamily is, and commercial real estate in general, is just the resiliency, how you're able to still increase value of your properties during a down market. And we'll go into that in some of the slides here. But what I wanted to share today was a case study of an example of how we could still remain profitable even when the values are dropping and the market is crashing due to high inflation, high interest rates. Multifamily is still most of the time resilient, and but it depends on the way you operate the property. Operations become more important in times like these than when the market is on your side, of course. Just briefly, a little bit about my company. So we have just a little over 4,000 units of both apartments and self-storage, around 100 million of assets under management. We've been in business now for a little over 4 years. And we'll be, launching a fund in the future that allows investors to invest in both assets. For now, we have just one asset at a time. And we are also vertically integrated with our own general contracting firm. Some investors like to know that we do everything in-house as far as our renovations and any construction. So this is what I mentioned earlier. What really allows multifamily to be an exceptional investment is the way they value the properties. And I'm going to speak to a beginner level just in case there are some beginners, that way I don't leave anyone out. So some may already understand this, but basically the way we value the apartments is you take the net operating income divided by the cap rate. So really half of that equation is able to be influenced by the owner and operator. Essentially any cost savings you implement, any additional revenue you add to the property, you're able to increase your NOI, even if the market is working against you. And in the example we'll see it later, I'll show how we've done that with one of our properties. But the capitalization rate or cap rate, typically, if you're familiar with the industry, like I am, I'm local in DFW, Texas. I understand what the cap rates are around here for different asset classes, but uh, the way you could figure it out is just looking at sales comps, talking to brokers. You could also back into it in the equation if you know the NOI and what the property sold for. But that's just a way that you can quickly increase value by just improving that NOI. So essentially, you could purchase an asset, make some improvements, and then sell it pretty quickly, and you don't have to wait for the market to build that appreciation for you. You can force that appreciation. So that's kind of how the value add strategy works. That's what we do with my firm. We look for value add opportunities that allow us to quickly increase the value. So we look for properties that their rents are under market and there's room to raise them. We look for properties that have maybe a lot of the units are outdated. They could use some revitalization to further increase rents on top of the just regular increase, getting them up to market. And then there's some other, opportunities that I can share a few of them on the next slide, where you can add covered parking, you can do other things to the property to save costs and add revenue to kind of speed up that appreciation. Before we get to that, just another advantage of multifamily is the depreciation tax savings. I would advise you check with your CPA, of course. They're going to be able to explain this the best as they're the tax experts. But one strategy we do back in 2017, there was the Tax Reform Act that was passed, and it essentially started out where you could get about up to 100% bonus depreciation. So essentially, when you purchase the asset, you perform a cost segregation study through a cost seg company. They would come out, do kind of an appraisal of your property, and they take certain parts of the property that are not part of the structure. So the cabinetry, the flooring, HVAC, plumbing, etc. And those items can be depreciated, over the items that can depreciate over 5 or 7 year term. That depreciation can be a lump sum up front. And so you would have the ability to get almost 100 up to 100% of your investment back in the form of a loss on your tax return. That has since started fading out. It was 100%, then it was 80%. Last year was 60%. I think this year will be 40%. It may get renewed, but we'll see if that legislation passes. That's just another advantage of your investment. You can, potentially save a lot of taxes. Okay, so here's the case study. We bought this property a couple years ago, showing here the original net operating income and then what it is now. So we've raised it just about 40%. The way we accomplish that, first of all, like I mentioned, we look for properties that are below market rents. So the owner of this property before us had not raised rents in quite some time. So there was an opportunity to get between 100 to 150 rent increases without having to perform any upgrades. So that was a huge benefit. We also implemented what's called a bulk cable internet package. So essentially, the local provider will give us a 50% discount on the cost. We'll put the entire property on one account, and then we pay the bill monthly, and then we will then, charge the tenants a monthly fee, and usually we will bake in a little premium on that. although it's still cheaper for the tenant than if they went out to try to procure their own service individually. So the tenants are happy, they're saving money. We're making some premium on that. And so we have been able to, recognize over 300,000 of value add from that, and about 2.5 million of value add from the rent increases. And then we also added some reserved parking spots, which was about another 100,000 of value add. One other thing we did was, and we're starting to do this on all of our properties now. Instead of the tenant paying a security deposit to us, they pay a fee. So that money, instead of going to us, it goes to a third party, and they get basically a bond. And if for some reason that tenant skips or is evicted, they don't pay their rent, whatever that bond amount was, we get reimbursed that money. So it's essentially almost like an insurance policy for the rent that helps cover us in situations where tenants aren't paying. But you have to just gauge it. The bond amount, they take a percentage, a fee of that bond amount. So you can't have too high of a bond amount. You have to, because then the fee would be too expensive for the tenant. So you just have to kind of navigate that. But that's also been a huge savings for us. These were the original projections. So we gave ourselves 3 years to refinance into another loan, and we were able to do that in 2 years. The current appraisal that we just got in the middle of the refinance was 13.7. We bought the property at 12.3, so we've added 1.4 million of value during these last couple of years, which were very challenging. So we consider that a win. If we had the market on our side, this would be a lot higher. But we're happy that a lot of properties have lost value the past couple of years, so we're happy that we've increased our value. The loan we're getting into is a lower interest rate, and so we'll be able to start cash flowing a lot better now once we complete this refinance. An example of this is the example for this property, but these are typical. We usually try to look for a 2x equity multiple within a 5-year term, give or take. And so if we can achieve that projection sooner, we typically do, but we'd like to give a runway of 5 years. So this is a typical example. Because of the high interest rates, this cash flow is a little bit lower than it would typically be on an apartment investment, but we're still aiming for that 2x equity multiple. So as compared to when the market's doing well, your cash flow might be a little bit better. So there you might be making maybe 2.2, 2.3x, but we still think a 2x is possible with this asset. We use AAR, average annualized return. It's a little bit, we find easier to understand for investors. We also calculate IRR, but the AAR is essentially, what your total returns are divided by the 5 years. So around 19%. You're earning around 19% average annual. And just a quick description of the property. This example was 92 units, kind of a healthy split between, the 1 and 2 bedrooms, and then some pictures of the interiors. So as you can see, we didn't really need to push too hard on interior renovations. They were already pretty decent condition. So we were able to, get away with the rent increases without having to spend money on upgrades. So that was it. And I saw there were some questions already.
Wow. Sorry, not really sure what happened with my camera there for a second. That was a new one. Yes, we got a couple questions actually about the referral for the company you work with for the security deposit bonds.
They're called Assurant. That's the one that we've started working with. There are several others. I'm sure that are just as good. That's the one we have started to work with. So the way that works is they will take typically about 40% fee of the bond amount. So what we found is in this market, the tenants typically an affordable fee for them is about $350. So that would get us around a $900 bond. And so that doesn't cover the entire rent, but it covers a good chunk of it. So we would be able to get that deposited in our account with usually within 48 hours if that happens. You don't have to do it for all tenants, but you could do it on a case by case basis.
Makes sense. And thank you for the questions. Real quick, we did have one during presentation asking if we will get copies of the slides. I did tell them that the replay of the webinar will be available on Camoplan's website after within the near future. But are these something that you would be able to send out to any registrants for the webinar?
Absolutely.
Awesome.
Happy
Great.
to.
Then we will, you can expect that. And then Rebecca asks, can you explain IRR and AAR, please? Thank you.
Yeah, so they're essentially very almost the same thing. I mean, IRR, we typically have to use a formula in Excel to correctly calculate. AAR is very much easier to calculate. You're just taking your overall returns. So whatever your total returns were in the entire 5 years, just divide that by five, and that's your average annual return. Typically, what I find is investors like, to target around 20%, give or take, between 18 to 20% IRR or AR. So that's typically what we look for, which really ends up being around a 2x in 5 years. So if the deal we're looking at does not hit those numbers, we tend to look elsewhere in order to be competitive, because I know there's a lot of people out there doing what we're doing, and those are the deals they're sending to investors. So to remain competitive, we usually try to hit that 20% annual return.
Awesome. And Matt is asking, is BreakChain a fund we can invest in directly, or is it available through Camoplan, or both?
Yeah, so we have currently we do one property at a time, but we are launching a fund that you would be able to invest directly in the fund, and that includes multiple properties. So it's a little bit more risk averse, where your investment is diversified a little bit more nicely, versus all in one property. So I can keep everyone updated when that is available.
And I take it that will include the ability to invest using their self-directed IRAs
Of
through
course,
Camoplan?
yes. Typically, almost half of our investors typically do some kind of self-directed IRA. So definitely talk to Camoplan about that.
Awesome. Uh, Thank you for the question. And I believe he has another one. Is the cash flow component paid out annually or upon exit?
The cash flow, we typically like to do it monthly. We find that investors appreciate getting that monthly deposit. That's typically an ACH. And it gives a level of comfort to see that coming in every month, to let just everyone know that things are working as planned. And it's just a level of comfort for everyone, so they're not wondering when or if they're going to get their distribution. It's just a regular monthly.
I can see why they'd appreciate that. Thank you for the question, Matt. Gregory asks, in the event of operator default, what recourse does an investor have when investing in a fund? Direct lending would provide security by way of a mortgage.
Yeah, typically what happens is it depends usually what type of loan. Usually we do non-recourse. So typically our loans are either Fannie or Freddie. Sometimes they're a CMBS loan or a bridge loan, but usually the lender would take back the property. But typically what limited partners can do, and if they feel like there's some uh, malpractice, they have the right to come together and take legal action. So it's important that the operator, what I find works is sending out monthly updates to all the limited partners, sharing the financials, and just being transparent. And that way, there's no questions or concerns. And even if the performance is having challenges, at least that is being made known and what the action plan is, and that there's no surprises.
Absolutely. Um, Great. Thank you for the question, Gregory. And if anyone else has any questions, I was going to say speak now or forever hold your peace, but it looks like someone is speaking. Robert asks, what do you anticipate your metrics to be for a fund?
Typically, we try to hit that 20% IRR metric. Um, Typically, we also try to hit at least our 7% annual cash on cash return. We'll sometimes do preferred returns. What we've found recently is investors are becoming more attracted to preferred returns, being that because of the high interest rates, it gives them extra level of comfort that even if the property is not cash flowing, their return is being accrued. So we will sometimes do a preferred return as well, but typically, yeah, we try to hit at least a 7% annual cash flow, and that 20% IRR.
Fantastic. When the Flex Fund is available, will you provide an informational session to learn more about it?
It's a very good idea.
I
Let's do
tend to
it.
agree. So keep an eye out for that because it sounds like that is possibly
Yeah.
now in motion. And she says you're welcome. So, and Jim Waters wants to know if he missed your contact info, and even if you did already put it up, could you possibly put it up again or let us know what it is?
Yes, thank you. I forgot to add that last slide. Shame on me. Can I put it in the chat here?
Absolutely, you can. And I'll be sure to include it in the description of the replay, both on YouTube and on Camaplan's website. I'll be sure to do that. Um, actually, I'm just gonna. There we go. So his email is joe@breakchaincapital.com, and I will be sure to include that in the replay. What's the track record of your fund and/or your firm? How many deals have you taken to full cycle?
So we are just about to do our first full cycle. We have currently 13 active properties, including self-storage properties. We've had 0 capital calls, and have not lost any investor capital. And so we're in the process of doing our first sale and our first refinance. Our first refinance should close in February, and the first sale hopefully in May, sometime in May.
Awesome. And Jeff asks, we've seen some syndications putting distributions on hold. Are you in that situation in any of your investments?
We did that on this property in the case study. And as soon as we complete that refinance next month, we will begin the distributions. But we let the investors know that ahead of time as we were closing on this we were in the midst of the interest rate hikes. So we had that was part of our plan in the beginning.
Fantastic. And Gregory asks, which asset class are you finding performs better in terms of cash flow? Multifamily or self-storage?
In terms of cash flow, it's going to be self-storage. The reason is there's very low operating expense. The expense ratio is typically around 30% versus apartments is closer to 50%. The trade-off, though, is um, the self-storage properties don't appreciate as greatly. They're usually just square boxes. There's no amenities, right? So you're going to get better appreciation. So the way it usually works out of your total returns, they both end up about the same returns in the end. But the difference is the self-storage properties, about half of your return is going to come out of the cash flow, and then the other half when you sell the property, versus apartments, maybe it's like 20% or so is coming from the cash flow, and then a bigger chunk at the end when you sell. You're also going to get some better depreciation from the apartments. Um, but those are kind of the differences.
And as a follow-up, he was wondering, have you ever done new construction self-storage? And if you have, which you prefer?
I have not. I've been starting to look at that. Um, it. I feel like the value add is less risky because I look for properties that are already performing, they're already working, and I can just step in and then make some improvements. Um, Building it from scratch, you have to make sure you're picking the right location, and then so there's a little bit more risk there, but sometimes they can turn out really well. So I've been looking at that as a next step.
And Rebecca's wondering if you are the primary syndicator or if you have others that also syndicate deals.
Yes, I am the primary sponsor.
Fantastic. Um, and I will give them a minute to see if any more questions come in. But if not, once again, Joe's email is joe@breakchaincapital.com. And I will include that linked in the replays. Um, we have a thank you for your time. And if no one else has any questions, then I am just going to thank Joe for his time and thank him for coming on and speaking with us and helping us learn today. So, Joe, thank you very much. And hopefully, we hear from you soon.
Pleasure. Thank you, guys.
All right. Have a good one, Joe, and have a good day, everybody.